Hey everyone, and welcome back to Investing Talk Podcast. It's earnings season again.
Oh,
And
yeah.
for investors, that means we've got a whirlwind of information coming our way.
A lot to digest, right?
Yeah, this week's going to be a busy one, so we're going to break down 10 companies
Okay.
that are reporting next week that we think you might want to keep an eye on.
Sounds good. I'm ready.
The market often reacts so strongly to earnings surprises, but you know that short-term volatility isn't always the best indicator of a company's long-term potential.
Right.
So let's take a look as we're kind of digging through these reports.
Yeah.
Let's think about what the numbers are really telling us about each company's story.
I love that. Okay, so let's start with Collegium Pharmaceutical, ticker symbol COLL. They are reporting their fourth quarter 2024 earnings on February 22nd.
Okay,
Their trailing 12-month earnings per share are sitting pretty at $4.80,
not bad.
with a pretty respectable 7.1% year-over-year revenue growth.
Those are some solid numbers for sure. But you know what really jumps out to me?
What's that? Is their surprisingly low price-to-earnings ratio. It's only 6.25.
Wow.
And their PG ratio, which, factors in future growth expectations,
Right.
is even lower at 0.42. So that could suggest that maybe the market isn't fully appreciating their potential.
Interesting. And they also recently completed a 4-for-1 stock split.
Oh, wow.
Now, it's not always a guaranteed sign. But stock splits can sometimes signal management's confidence in future growth.
True.
And it also makes the stock more accessible to retail investors. So it'll be really interesting to see how the market responds to their report with all these factors in play.
I agree with that. Now let's switch gears a little bit
Okay.
to Upbound Group, ticker symbol UPBD. They are reporting before the market opens on February 20th. And this one has a lot to offer, I think, for income-focused investors.
Oh, yeah. How so?
Well, they're boasting a 5.25% dividend yield
Okay.
with a very healthy 7.91% year-over-year growth.
That's pretty good. And, they're not just resting on their laurels. Their revenue is actually projected to approach $1.1 billion in Q3 2024.
Wow.
And their full-year guidance is actually looking pretty optimistic.
I like it.
It seems like a lot of this momentum is being driven by their asthma segment, which saw a whopping 19% year-over-year revenue growth.
That is whopping. What I find fascinating about them is
Yeah.
their expansion strategy.
Okay.
So they're exploring new opportunities in Mexico, which could be a huge growth market, if they can navigate the complexities of
Right.
entering a new region. And they're also focusing on digital enhancements, which tells me that they're adapting to changing consumer behavior.
That's smart. All right, next on our list is Genco Shipping and Trading, ticker symbol GNK, reporting their quarterly earnings on February 19th.
Okay.
This one is a little bit of a high-stakes game, I think, for dividend investors.
Oh, how so?
Well, they are offering a very tempting 10.9% yield, but
There's always a but, right?
always a but.
With those sky-high yields, their payout ratio is a hefty 98%.
What does that mean?
So that means that they are distributing almost all of their earnings as
Right.
dividends. Now analysts are actually predicting a decline Oh. in both earnings per share and revenue for Genco.
So does that mean they can't sustain this level of payout?
That's the million-dollar question, right? But don't hit the panic button just yet. Genco has a pretty strong financial foundation.
Okay, that's good.
Their debt-to-equity ratio is only 7.7%, and their interest coverage ratio is a very healthy 8.3 times. So they're not teetering on the edge financially.
That's reassuring.
It's a classic case of weighing that potential reward against risk. This could be what some might call a value play.
Okay,
It's a fundamentally solid company that's just facing maybe some temporary challenges.
I see.
The key here will be to see how their actual numbers compare to analyst expectations and to really assess management's outlook on their ability to maintain that dividend.
All right, moving on to a company that's attracting a lot of attention from analysts.
Okay, who's that?
That is Taseko Mines, ticker symbol TGB, reporting on March 6th.
Okay.
They currently have a strong buy rating, with analysts projecting a potential upside of 62.04%,
Wow.
based on a $3.50 price target.
Now, those are some pretty bullish projections, and, they're rooted in some pretty impressive growth figures.
Oh, like what?
Well, they've achieved a 60.7% average annual earnings growth over the past 5 years,
That's amazing.
and they hit a record annual revenue of $525 million in 2023. So this isn't just hype. It's backed by real performance.
That's great.
But, of course, no investment is without its risks, right?
True. In Taseko's case, their debt-to-equity ratio is a bit on the high side, 160.1%.
Okay, so what does that mean?
Well, that means they're using a lot of borrowed money to fuel their growth, which can amplify returns, of course. But it also magnifies the risk if things don't go as planned.
Debt is always a double-edged sword. It's definitely something for investors to consider carefully.
Absolutely.
Now let's dive into Genthern, ticker symbol THRM, reporting before the market opens on February 19th. Their recent earnings growth has been quite remarkable.
In what way?
Well, it's reached 275.1% over the past year, and that's exceeding industry averages. This does come after a period of decline, though, so it seems like they've turned a corner.
That's good. What I think is really impressive is their consistent double-digit revenue growth, averaging 11.5% annually. That indicates strong and growing demand for their products. And when you combine that strong performance with their forward price-to-earnings ratio of 13.41, it makes you wonder if they might be undervalued by the market.
It does make you wonder.
They also boast good financial health, reasonable debt levels, and strong liquidity. So this could make them a very compelling option for investors seeking growth opportunity.
For sure.
Now let's talk about Cable One,
Okay.
ticker symbol CABO, reporting on February 27th. At first glance, they seem very appealing to income-seeking investors.
Why is that?
Well, they have a 4.2% dividend yield
Okay.
and a reasonable 30% payout ratio.
But if we dig a little deeper,
Oh no, what do we see?
some potential red flags.
I would.
Well, they've been experiencing a concerning trend of declining revenue, and they've missed EPS estimates in recent quarters. And on top of that, their debt-to-equity ratio is sitting at a rather high 185.3%.
So the upcoming earnings call is going to be crucial for Cable One?
I think so. Investors will be looking for signs of a turnaround and some reassurances about their ability to manage that debt load.
Absolutely.
Now for a bit of a mystery company.
Oh, okay. I like a good mystery.
Anderson's, ticker symbol ANDE. We don't have a specific reporting date just yet, but we know it's coming up soon.
Okay.
What we do know is that they have consistently exceeded EPS estimates in recent quarters.
That's always a positive sign.
It is. They've also got a healthy operating cash flow of $87.6 million and offer a stable 3.2% dividend yield. Their diversified business model, which spans trade, renewables, and nutrient and industrial segments, could provide some insulation from economic volatility.
That makes sense. Let's move on to Savers Value Village, ticker symbol SVV, reporting their fourth quarter and fiscal year 2024 results on February 20th. After market closes, they hold a unique position as the largest for-profit thrift operator in both the U.S. and Canada.
That's interesting. So this appeals to investors who are interested in the circular economy and sustainable retail.
Now I get.
Their financials paint a bit of a mixed picture.
Oh, how so?
Well, on the positive side, they've got strong earnings growth, averaging 22.7% annually, and a healthy 17.3% return on equity.
That's great.
However, they're carrying a significant debt load
Uh-oh.
with a debt-to-equity ratio of 171.3%. So that high debt level is certainly something to watch closely. But what is interesting is that despite recent analyst concerns about growth and margins, they have been experiencing growth in returns on capital.
So that could be a positive sign for the future.
It could be, but it's a situation that definitely warrants further investigation.
For sure.
Now buckle up for Starbolt Carriers.
Okay.
Ticker symbol SBLK, reporting fourth quarter 2024 earnings. On February 18th, after market close, they're projected to have a significant year-over-year decrease in EPS.
Like how much?
42.5%.
That sounds kind of alarming.
It definitely grabs your attention. But before jumping to conclusions, let's also consider that their revenue is still expected to grow by 9%.
Okay.
This suggests that the EPS decline might be due to temporary factors, rather than a fundamental problem with their business.
That makes sense.
And they're not in a precarious financial position either. They have a manageable debt-to-equity ratio.
Good.
Plus, they've been outperforming the shipping industry average in terms of ERG's growth.
That's a good sign.
So this is one where you'll want to look beyond the headline numbers and really understand the context behind the results.
Absolutely.
Last but not least, we have World Kinect, ticker symbol WKC, reporting their fourth quarter 2024 earnings on February 20th. Their forward price-to-earnings ratio for 2024 is 9.46 times,
Okay.
which might indicate that they're currently undervalued by the market.
Interesting.
They've also been delivering consistent dividend growth and boast stable financial health.
That's great.
However, there is one potential red flag.
What's that?
Revenue is projected to decrease by 12%.
Oh, so that projected revenue decline definitely warrants a closer look.
It does.
We'll want to understand the underlying reasons for it.
For sure.
Is it due to industry-specific challenges, loss of market share pricing pressure, or something else entirely?
Exactly. Once we have that context, we can assess whether it's a temporary blip or a sign of a more fundamental issue.
Right. You know, it's interesting how each of these companies operates within a specific industry landscape, And, you know, that context is so important when we're interpreting their earnings reports.
Right.
So, for example, Genco Shipping and Starbolt Carriers, they both operate in the shipping industry,
Uh-huh.
which is known for its cyclical nature.
Yeah, that's a great point. Things like global trade volumes, commodity prices, even geopolitical events can have a huge impact on a shipping company's bottom line. So you can't just look at their financials in isolation. You have to consider those broader industry dynamics at play.
Exactly. And then we have Collegium Pharmaceutical in the pharmaceutical sector,
Wait.
where, you know, regulatory approvals, drug pricing, research and development breakthroughs, all of those things can make or break a company.
That's true.
So understanding these industry-specific drivers is so crucial for making informed investment decisions.
It's like you said, having a piece of the puzzle. You need the whole picture
Right.
to see how it fits together.
Yeah.
Now, aside from industry trends, we also have to think about the overall economic climate.
Right.
Interest rates, inflation, consumer confidence, all of these factors can really influence a company's performance.
It's true, a company might be executing well on its own strategy, but if the economy takes a downturn, it can still impact their results.
For sure.
It's all interconnected.
It is. And, let's not forget about the role of sentiment.
Right.
In market psychology, sometimes a company can deliver strong earnings, but if investors are kind of spooked by something else,
Yeah.
like a geopolitical event or a change in interest rates, the stock price might not reflect the company's true value.
That's so true. The market doesn't always behave rationally in the short term. It doesn't. But over the long term, fundamentals tend to win out. That's why it's so important to focus on a company's long-term prospects
Right.
rather than getting caught up in short-term market swings.
I agree. If you believe in a company's story, its management team, and its ability to execute on its strategy, those short-term fluctuations shouldn't deter you from investing.
Totally.
Now, speaking of fundamentals, let's kind of revisit those financial health metrics
Okay.
we discussed earlier. Things like debt levels, liquidity ratios, and interest coverage. These can provide some valuable insights into a company's financial stability.
Definitely we highlighted Taseko Mines and Savers Value Village, which both have relatively high debt-to-equity ratios.
Right.
While their growth might be enticing, it's important to understand how that debt could affect their flexibility and profitability if the economy weakens or their industry faces headwinds.
High debt can be a double-edged sword. It can really accelerate growth in good times.
Right.
But it can also amplify losses in bad times. So if you're thinking about investing in a company with a high debt load, you really need to kind of assess whether you're comfortable with that level of risk.
That makes sense. Now, shifting gears a bit,
Okay.
let's touch on some of the unique aspects of certain companies. We mentioned that Upbound Group is exploring expansion into Mexico.
Yes,
That's a potentially lucrative market,
it is.
but it also comes with its own set of challenges and uncertainties.
Absolutely. When a company enters a new market, you have to think about several factors.
Like what?
Well, do they have a deep understanding of the local consumer base? Can they navigate the regulatory landscape? And can they compete effectively with the established players in that market? So, international expansion can be a great growth strategy, but it's not without its risk.
Right. On a similar note, we talked about Savers Value Village's position. As a leader in the circular economy, this is a growing trend as consumers become more environmentally conscious and are seeking out sustainable products.
Yeah, it's fascinating to see how companies are adapting to these evolving consumer preferences. I think for Savers Value Village, their business model of reselling and repurposing used goods could give them a competitive edge in this growing market. It aligns perfectly with the increasing demand for sustainability.
Okay, one last thought before we wrap up. We've been talking about financial metrics, industry trends, and all these external factors.
Uh-huh.
But let's not forget about the importance of management quality.
Oh, I couldn't agree more. A company can have all the right numbers on paper, but if the leadership team is ineffective, makes poor decisions, or lacks vision, it can all go downhill really quickly.
So as you're researching these companies, pay attention to their track record, their strategic vision, and their communication with investors. These are all clues that can help you assess whether a company is well managed and positioned for long-term success.
It's often said that you should invest in the jockey, not just the horse. A skilled and trustworthy management team can make all the difference.
Now bringing it back to World Kinect, the last company on our list. They're facing a projected revenue decline, which always raises a red flag for investors.
It does.
But as we've been discussing, it's important to dig deeper
Yes.
and understand the full context.
Exactly. We need to understand the reasons behind that decline.
Is it due to broader industry challenges, loss of market share pricing pressure, or something else entirely?
Is it a temporary setback or a sign of a more fundamental problem?
Sometimes a revenue decline could be a strategic move, like divesting a non-core business. or shifting focus to higher margin products.
Right.
It's all about understanding the narrative behind the numbers.
And that's where those deeper dive research efforts come in. Listening to earnings calls, reading analyst reports, and conducting your own independent analysis can help you separate the signal from the noise and make more informed investment decisions.
So as we wrap up our look at these 10 companies, it's a good reminder that earnings season is a marathon, not a sprint.
I like that analogy. You can get so caught up in the daily headlines and stock price movements.
But the real insights come from taking a step back and understanding those long-term trends.
I agree. We've highlighted some companies with impressive growth, some fading challenges, and some with really unique positions in those evolving markets.
Right.
It's all about piecing together that puzzle to see which companies really fit your investment style and risk tolerance.
And remember, diversification is key. Don't put all your eggs in one basket.
True.
Spreading your investments across different sectors and industries can help mitigate risk.
Absolutely. And as always, we encourage everyone to do their own research before making any investment decisions.
Please.
We're just offering a starting point here, a way to spark your curiosity and guide your exploration.
Investing is a continuous learning process. There's always something new to discover, new trends to analyze, new opportunities to consider.
Well, that's a wrap for us on our earnings preview for this exciting week ahead. We hope you found this discussion insightful and helpful as you continue to navigate the world of investing. If you enjoyed this episode, we'd love for you to subscribe to Investing Talk Podcast and share it with anyone who might be interested in learning more about the market.
And don't forget to leave us a comment. We are always eager to hear your thoughts, questions, and what companies you're keeping an eye on.
Thanks for joining us and happy investing!